Happy New Year! It's 2026 and I have no idea where my life has gone for real. Seriously, where does time go? But most importantly, what is going to happen with the economy this year? That's what I'm here to talk about today. I don't have an easy way of explaining this, but I think it's going to be a super duper volatile year. It's one where the stock market could shoot up, it could really rally, it could just crash and burn, it could do both. I don't know. So let's take a deep dive and look at what are the big opportunities and risks this year. On one hand, big banks and analysts think that we're going to have another strong year and stocks will shoot up by another 10 to 15% by the end of the year. The key drivers obviously are AI, along with defense, aerospace, healthcare, biotech, and energy. These industries are booming and we expect them to grow. There's also the big focus on onshoring production in critical industries, which hopefully leads to more domestic job creation. So, yes, there's a lot of optimism for continued growth and innovation, and hopefully it could end up being a really good year. But then there's also a lot of reasons for pessimism and there truly are some really serious risks on the horizon. So, first and foremost are politics and tariffs. Shocker. We've got midterm elections coming up, and so far, Congress has been largely ineffective. There could be another government shutdown, and the big question remains what's going to happen with these dang tariffs? Well, the legality of Trump's tariffs is currently sitting with the Supreme Court, and it kind of seems like they might be illegal. So, likely the scenario is that the court allows them to continue temporarily, and ultimately the decision will be kicked to Congress, and hopefully they can decide. Now, realistically, tariffs will probably continue because it would be an absolute disaster if they took away tariffs at this point in time. So, during this deliberation, we can see a lot of rattling of the markets. Then, of course, there's icky, sticky inflation. So, for now, inflation is kind of here to stay and it might even go back up. A lot of this depends on the value of the dollar, which has been weakening. And if it continues, imports will get more expensive. And that means higher prices for things like cars, clothes, and other goods produced abroad. Now, with rising unemployment, stagnant job growth, massive increase in health insurance costs, and forced student loan payments, the everyday consumer is getting super squeezed, and we are likely to see a surge in personal debt. So, this would cause consumer spending to stagnate, and that hits traditional industries like retail, manufacturing, home building, and commercial real estate. So, in response, the Fed has been lowering interest rates to stimulate the economy. But yet another risk is that bond yields can still rise. So, what does this mean? It means that if investors don't want to buy US bonds because they think our economy is not attractive anymore because of rising debt and lowered growth outlooks, then basically bond interest rates will rise so that people get a bang for their buck when they invest in bonds. That's problematic because that would cause borrowing rates to go up and more pressure on things like stocks, housing, and refinancing. We also need to watch out for private credit because if that starts to crack, as in with the case with Oracle, and lenders can't keep funding AI, that could cause a serious recession. And the government would basically have to bail out big tech, and there's already some talks about this. There's also the Japanese carry trade. I did a whole video on that. Not going to talk about it here, but go check it out. Basically, people could just stop dumping their investments in the US because they need to pay off their loans in Japan. And to top it all off, there's a potential black swan situation with China and Taiwan. If any escalation happens with Taiwan and China blocks the island, it would be like an immediate severe crash because most of the advanced computer and AI chips are produced in Taiwan. Now, it likely won't happen, but it's still a risk, and we were hearing about it in the news. So, all in all, if you take a step back, we got a lot of risks. Most of our eggs are in the AI basket, and while it's driving growth without sound economic policies in this continuation of a K-shaped economy, we're just relying too much on tech, and there's so many financial risks. So yeah, we could have a great year if tech does take off and carries the economy. Or we could just have a serious market crash like Michael Burry is saying. Who knows? Let's stay informed. I'm here to tell you along the way. Stay tuned.